Hello, everyone. My name is Ibrahim Sani. Joining us this week is Dr. Sailesh Kumar Jha, the Group Chief Economist and Head of Market Research at RHB Bank. He will be sharing with us some of his insights into the 2022 global market and economic outlook. I'd like to welcome Dr. Jha and many of you joining us in this conversation today. To recap, the second half of the year has been quite volatile, and quarter four more so than most. Inflation fears do persist with expectation of an earlier than expected interest rate hike. Concerns of a QE tapering continues to linger, and the reduction of liquidity in the capital market persists. Not to mention China regulatory crackdown, especially in the realm of tech, and of course, there's no signs of easing. On top of it all, just to put icing on the cake, Omicron, COVID-19 variant fear continues to scare us or continues to put policymakers in a tough spot. The reimposition of travel ban, for instance, to southern African countries continue. So we need to do a quick recap into what is going to be shaping up for 2022. So, Dr. Jha, to kick things off today, maybe we can start with your view on what you think the global equities will look like for the entire year of 2022.
Yeah, so we just published our report on Friday night, our 2022 annual outlook. And for your viewers, the key message really is that sunshine is coming despite bouts of showers. I mean, coincidentally, it is starting. Looks like it's going to start to rain here in Kuala Lumpur, your beautiful city. But the key message really is, from an equities perspective, we first think about, for investors, how do we guide them on the overall asset allocation in their portfolio? And so we are actually overweight equities. We are market weight fixed income and underweight cash. And within the overweight, we've also added this time around alternative assets. Typically, what we find is that to hedge out any volatility, as you mentioned, a plethora of risks out there, the wall of worry, as the Americans say, is out there. You hedge out your risk by buying bonds. But because we are in a situation where inflation risks are fairly elevated in 2022, global central banks trying to withdraw monetary accommodation and the market pricing in substantive rate hikes globally, we cannot hedge out the risk via bonds. So we have recommended now alternative assets like REITs, property, and some basically currency-related assets. So that's our overall asset allocation. Equities, we like it. As you can see, we have an overweight globally, on equity market. And within equity market, it's important to recognize, with all the risks that we have, let me tell you our main risks, or our main macro risk that we think will be prevalent for the majority of 2022. Top of the bat, it is essentially the Fed risks in terms of what is their path of monetary policy. The second is in terms of supply chain disruptions, which you've heard about a lot recently. We have provided quite a bit of evidence in our report on Friday night. It seems to be a little bit of a US-centric, Europe-centric event risk. But those risks are going to pick up here in Asia as the economies in this part of the world recover. China-related risks, significant, right? Those risks are going to be with us. And we have also factored in that the COVID-19 pandemic, people were looking for transition to endemic, but the pandemic is going to remain a pandemic in 2022. Omicron is not the end of the road in terms of new variants, more likely than not. Hopefully not, but we put that in our base case, is that there are going to be new variants coming out. So in the equities world, where do we invest? Right? It's easy to say to be overweight equities. Yeah, sure, but what do we actually buy? So our buy on dips recommendation is in the United States. We are mainly long DM, short EM. Within DM, we like the United States. Within emerging markets, you have to have some allocation. You can't go to totally zero because we're not heading into any sort of crisis. We like India, and we essentially like parts of Southeast Asia, like Indonesia, home-based Malaysia, Thailand, and we're avoiding anything that's related to China and China in itself. For us, China is a sell-on rally. And with that, basically, it'll take with it in terms of that sell down North Asia. And in Southeast Asia, least favored is Singapore, which, as you know, the Singapore equity market has done fabulously well this year. But it's not going to repeat that performance because the Singapore business cycle and market cycle is more closely linked to China. So that's our brief overview.
All right, so we heard from you just now the classifications, which ones you are overweight, which ones you are underweight. We've also heard the kind of risks and the mitigating views that you have on those risks. And finally, we've heard on some of the geographies that you want to go in. Most global indices, however, have reached its all-time high in 2021. You alluded to Singapore, for instance, many of them, and no longer considered cheap in terms of valuation. Because of this, do you feel that we on the right footing for a sustainable global economic recovery justifying the existing valuation?
Yeah, so we have penciled in a path. What is different sitting here today in December 2021 as opposed to when I first started writing for the bank? I joined RHB Group on November 5, and we published 2020. We've published our first global market economic outlook in the first week of December. The difference was at that point of time, basically, it was a recovery of sorts, where the recovery was relegated more to the United States, followed by essentially Europe. This time around, the big difference is it's a synchronized recovery path across developing markets and essentially major emerging markets. And we have factored in the China risk, where what we're seeing from our very high-tech machine learning derived high frequency data for China available until the third week of November, okay, is stabilization. Stable China, rest of the world evolving nicely on a moderate growth recovery path means that we'll be at trend in terms of global growth by middle of next year. So yes, the global growth backdrop is quite okay for the outlook for equity market. You asked the associated important question: valuations and liquidity. I would add into your valuations question, I'll add in the liquidity aspect. So what happens in market cycle as we head into, remember that the Fed hike is upon us. Let me give the RHB view. The RHB group view is that the Fed, along with other major central banks in the world, are going to be in a moderate hiking cycle, moderate removal of monetary policy accommodation cycle. They are not going to go along with what the markets are pricing in of significant policy rate hikes commencing in the second half of the year and following through of aggressive hikes in 2023. We have penciled in 25 basis point hike by the Fed only in the second half of next year, and followed through by 50 basis point in the first half of next year. And it's a slow path to the normalization. What exactly is the terminal point of where the Fed funds rate, along with rates controlled by the ECB, European Central Bank, will be, is an open question. But our base case is a very gradual path of reducing monetary accommodation and hikes. With that in mind, it's important to recognize that liquidity is going to be fairly ample from an equities perspective. We find a very strong relationship between liquidity indicators such as global money supply and the equity market performance, as well as basically global money supply and total returns on high quality bonds like investment grade bonds in terms of at a global level. Where we get the most impact on basically returns from a less accommodative, not tight. Remember, I'm saying less accommodative major global central bank framework is in the bonds world, not in the equities world. Equities world, what happens is as we go into the first hike, the market does correct. We're positioned for that in the sense that the market corrects roughly over the last three Fed hiking cycles, starting when we looked at it in the 90s all the way to the most recent hiking cycle of 2015. Corrects by 4 to 13% in terms of the global MSCI index, but quickly recovers after the first hike. The global MSCI index, it's a world equity market, very representative, recovers by 3 months after the first hike. In plain English, we're looking for that dip. That dip is arising already because we have other risks out there, COVID-19, we have China, you name it. So when we're thinking about advising investors, we're actually looking for the dip and scaling in on those dips. The markets will correct, but it's basically we're in the camp of buy on dips rather than sell on a rally, as some people, financial market participants, would like to have you believe. It's great that we have two types of people, right? Two camps, because it is a marketplace.
Speaking about US, global indices are technology sector heavy, particularly in the US tech companies. What are your views on the tech sector for next year?
So fundamentally, yes, the tech sector will undergo periods of correction that we're already seeing, like the Nasdaq. You know, where the challenge has been for tech is twofold. One is the strong dollar, and essentially the direction and the level of 10-year bond yields. As you know, the dollar and the bond yields are related. Okay, they're kind of like mirror images of themselves. So what we're thinking is fundamentally, if you have so our base case is that the pandemic lasts for the 2000 for the duration of 2022. We won't be escaping this kind of situation where most of us are working from home, right? And the idea that our movements will be very much restricted from a fundamental perspective is tech positive. Okay, that's a pure fundamental argument. But then when we look at the market environment, where basically markets are reacting to the idea that monetary policy is going to tighten quite a bit, long-term interest rates are going to go up huge, right? And in that environment, typically tech will not perform. But we're of the view that the market is overpriced in terms of how much expectation is building in terms of Fed rate hikes. The market's pricing in roughly, depending on the day, around 50 basis point hike in the second half, and potentially another 50 basis point, 75 basis point hike in 2023. We have 25 basis points for the second half of this of 2022, and 50 basis point in 2023, and let's see where we go from there. So this mispricing is what's causing, from a market's perspective, tech sector, big indices such as Nasdaq to be sold down. And with this pricing of significant policy interest rate hikes by the Fed, it's led to also strong dollar. So we've been in the strong dollar camp since December 2020, when nobody was favoring the dollar. We were bullish. Now that our view has come forth, we think that as the market mostly prices in the trajectory of Fed and global central banks' monetary policy path, the dollar peaks sometime in second quarter of next year, and then starts weakening modestly against Asian currencies, against the rest of the world in the second half of the year. Stabilization of bond yields from a market perspective, combined with the fundamentals that I've just given you, our position are going in the right direction of essentially a recovery of tech. That's how we would characterize our view on the tech sector.
Markets have been swinging back and forth between growth and cyclical and some extent dividend yielding sectors. Dr. Jha, are there any other sectors you prefer excluding tech? Maybe on commodities, energy, financials, REITs, healthcare, or something others like this?
Yeah. So, to reiterate, the overweight we have globally is not only equities, but also alternative assets. So in the equity space, we continue to think that the tech sector will do well next year. We also like, on back of the supply chain disruptions, that we're seeing in the US and which will spread globally. Transport companies, transport sector, logistics sector, healthcare is looking pretty good. And essentially, furthermore, in addition to equities in the alternative space, commodities looking pretty good, right? That's part of our overweight. Things like oil, food are likely to remain fairly resilient. And also within the alternative space, we like the REITs, which will still be paying us hefty interest rate differential between long-term bond yields in many parts of the world. And third, like hard assets such as property, whether it's the residential and commercial, selectively around the world. That's how I would characterize our more detailed sectoral preferences.
And of course, I want to touch a little bit more about Omicron, not just because the World Health Organization has labeled it as a variant of concern, and not just because some countries have introduced travel restrictions. My point, in fact, I want to get your views on this, is that there's going to be variants of concerns or variants of interest that's going to come out every so often. It can be, one VOC every quarter, or it can be 10 VOCs every month. We don't know. And while we have been living in COVID, a lot of countries, Singapore and to some extent Malaysia, has now embraced that whole notion of living with the COVID endemic situation. So how does this factor in when it comes to market outlook and investing decisions for 2022 on the back of stories or news like Omicron taking over the headlines of recent days?
So the headlines will create bouts of volatility and bouts of risk aversion. That's what we're seeing over the last 2 weeks. These headlines have an impact. It's not that they don't, but the thing to focus on, I would say, is that is it going to lead to a situation where we get the dynamics of lockdowns like in 2020, right? In starting from the second quarter, late first quarter of 2020, and into the first half of this year, and more specifically, via example, let me illustrate in home-based Malaysia, are we going to get like MCO1 and MCO3 type of curtailment of activity? Or is it going to be closer to MCO2? So we need to make a call. Is that what type of curtailment of activity via types of lockdown are going to come forth? It is not inconceivable that geographic within each major geography. So, for example, we have to make an assumption of what's going to happen, let's say in the US, which is the main driver of growth of the world. You will essentially get selective, not lockdowns, but curtailment of movement in select geographies. There could be periods of time wherein you get the supply side being restrained by maybe around 10% or so. That's possible, right? And in our world, in Asia ex Japan, the idea of getting a countrywide lockdown, unless you tell me a story wherein the number of people who get hospitalized, the basically number of people who are requiring ICU beds is on an explosive path, and there's supply demand imbalances in both, in terms of number of hospital beds, in terms of ICU units, and in terms of death rate, mortality rate, just going on an exponential path that we had in 2020 and 2021. We probably won't have that because the medical community, in terms of the infrastructure via government policy, is far more prepared for new variants. The drug makers simply are. Like, I'm sure you've heard the news from Pfizer that they were already contemplating, hey, we're probably going to get new variants. Let's see where we go in terms of coming out with the solution. So the conclusion really is, in our baseline for the market and economic outlook, we factored in the idea new cases will come out, but policymakers, economic agents such as yourselves and myself, consumers and businesses, are in a far better position currently and into 2022 to handle these new variants. It is a downside risk in our assessment. We've highlighted that as one of our top downside risks. That if again we're getting into national level lockdown, severe spread of infections, it's going to derail our, a lot of things, including our asset allocation and our positive view on equity markets.
You were mentioning just now about some of the risks that you take note of. One of them is, of course, global supply chain. And this has disrupted everyone, quite literally. I mean, my Apple Watch is not being delivered, even though I ordered it 4 weeks ago. So those are the trivial stuff, but the more serious stuff is, of course, like Pfizer has mentioned, drug supplies, vaccine supplies to markets have been slowed down. And of course, this will slow down vaccination rates across countries. And of course, this does create inevitably the increase of global inflation, particularly in the factory gate price, consumer price, and commodity price. Do you agree that inflation is transitory, and why would you hold this view? And perhaps how can investors protect their investment value from this possibility of rising inflation?
Right. I mean, that's a very good question. So, we have access to data of tracking supply chain disruptions in the US. And again, remember, the US is the most important and biggest market in the world, okay? Both from the market and economic perspective, and it does drive global growth. So we have to start somewhere, what to track, and then feed it to the rest of the world. What are the implications? So our proprietary database, let me give you the key message first and go through the details. I'm a sell side analyst, so I should give you the conclusion first. Okay, the conclusion is that a good sell side analyst. Okay, I hope. But bottom line is that as the U.S. supply chain disruptions remain with us in 2022, they will remain with us. That's our base case. Okay. Second, we need to understand that what has been predominantly a U.S. Europe type of supply chain disruption theme is going to expand to Asia ex Japan. We're not going to be spared. And the reason is that the people say supply chain disruption is a supply side shock. It's not. It's a combination of supply and demand. You think about it. Take a concrete example of things that all of you have heard about. You've read about this extensively, so you can tell that I'm not making up a story. Okay, at the port of Los Angeles, there's no trucks available to ship those goods inland, whether it's to West Coast destinations, logistics centers, whether it's to Midwest or to East Coast. And we track that data, by the way, and I'll explain it a little bit. If there's no demand, if demand is not strong, then you're not going to basically getting those shortages of trucks and truck drivers to transport those goods from Port of Los Angeles to wherever they're going, isn't it? So it's a big fallacy that we see in markets that, this is just, it's not. Demand is strong. And as long as demand is strong and global growth, including Asia ex Japan, is on a recovery path, and this pandemic remains with us, and it's not, and the impact of pandemic on supply chain linkages doesn't get sorted out, and they're not trivial. This is not a big picture thing. Literally, in the US example, the anecdotal evidence, and I'll corroborate that with the details of the data, truck drivers are in shortage, one, because of pandemic. They don't want to catch the virus. Point number one. Point number two is they don't want to do this for a living anymore. It's a hard job. And why do they have the opportunity not to do this for a living after they've been doing it for decades? Simply because labor market conditions are hot in the US and they have alternative job opportunities with potentially same or higher wage. I don't think that's just a US centric phenomenon. As the recovery gathers steam, we will get that happening in other parts of the world. Let me talk about the data in a bit, rather than just tell you these stories. So when we look at the percentage of ports in the US which are congested, in the last 2 weeks, from where we've been tracking the data, has gone up from 30% of ports are congested to 40% of ports are completely congested and hence low activity. They just cannot, stuff cannot be moved because there's just too much congestion and not enough trucks and drivers to bring them inland. How do we track that inland distribution? We have basically U.S. inland, logistics center. We track that, and we find from that tracker is that activity is very low. So there's that gap. Ports coming in completely congested, no truck to basically ship that stuff anywhere. Demand conditions, when we track demand conditions at truck stops around major truck stops in the United States, it's running above 2000, the pre-COVID 19 levels. Strong demand as we head into the holiday season. So that's what I'm saying. You got to put two and two together. The demand side, strong, hence supply side, all clogged up. How does that matter for us here in Asia? This guy's talking with his American accent about the United States. What the hell does this have to do, excuse my English, with Asia, Japan? It has everything to do with it. Because in Asia, what we're seeing is a nice, firm recovery path. I won't say it's like super bullish, all in, looks blue skies. No. Even with this moderate recovery path, we are seeing now that growth relative to potential, because remember potential growth has come down, obvious, right, because of the pandemic, right? So actually growth is now running above trend, above potential, and it's going to get even better, meaning that growth is going to remain even more above trend because trend growth has been brought down due to the pandemic, and it's going to continue to be above trend in 2022, which means as we're opening up this supply chain issues with the pandemic with us, and in this part of the world, it's not clear to me how prepared we are of these logistical issues. It's gonna expand to this part of the world in terms of the supply chain congestions, and to the point, long-winded story or long-winded data-driven story is that inflation is not transitory. We've had that view since April of last year, right? And it is going to be fairly elevated in 2022. In the US, we've revised up our 2022 inflation forecast. In Europe, we've revised up our 2022 inflation forecast. We've revised up our inflation forecast for 2022 for Malaysia, Indonesia, Singapore. We've revised most of our economists, who all obviously report into me, but nevertheless, I need to pitch their view, being a good manager, hopefully. It revised up. So we don't see any signs of inflation coming down in 2022, which puts us in a big paradox or a big dilemma. Inflation running high, growth above trend, COVID risk out there, China-related risk out there. Overnight, we get news of potential Russian issues with Ukraine again. Those downside risks upon us. What does the central bank do? Steady as she goes. Slow progression. They have to. They cannot hike aggressively.
It's important for me to ask you this question now. When you say central banks steady as she goes, it's important for us to look back at quantitative easing program. Some central banks have signaled a possible interest rate hike for 2022. I want to ask you what your view is on this. Also, how many times do you feel or do you think that the Federal Reserve rates hike do you foresee in 2022? And perhaps likewise, do you expect a pullback in global equity markets during the course of the QE tapering cycle following this possibility of an interest rate hike?
Yeah, so one of our big macro themes that markets will be focused on is obviously the Fed, right? And our base case is that the Fed is going to let inflation run hot a bit. I don't think I'm telling you anything new, but in the orders of what we're thinking is that the Fed hikes by 25 basis points in the second half of next year, an additional 50 basis point hike in 2023 in the first half, and it's well below what the market is currently anticipating. Okay, for the second half of next year, the markets are anticipating a 50 basis point hike by in second half, and followed through by another 50 basis point hike in basically in first half of 2023 at least. So they're looking for a quantum of like around 100 basis points or so at least. I'm just saying at least. It changes day by day. In some days, the cumulative hikes between first half, second half 2022 to first half goes all the way to 100, 150, 50 basis points. And today we're sitting at roughly around 100 basis points. Our core view all along is we're going to fade it. The Fed is going to hike 25 and 50, 75 basis points between second half of 2022 and first half of 2023 would be our base case. And in that environment, what we will notice is that the monetary conditions still look fairly robust, fairly ample, I would say. And that's good for equities. Liquidity is good. Okay. And as I mentioned earlier, it is one shouldn't be surprised that as we enter into the first hike, that the market gets sold because people are trying to price stuff. How much will the Fed hike? How much will inflation be controlled by tighter monetary policy? What impact will it have on growth? All the dimensions of concern that we get at the start of a hiking cycle or preamble. Okay, and today more complicated because of the Omicron variant, right, which you eloquently brought out earlier. The orders of magnitude, the last three hiking cycles: February '94, the start of a hiking cycle; June 2004, another hiking cycle; and December 2015, start of another hiking. The three hiking cycles preceding the potential hiking cycle commencing in the second half of 2022 for us. The orders of magnitude of sell down in global equity markets was 4 to 13%. The 13% occurred in December 2015, where we were in a far more difficult situation than today. China hard landing risk in summer, if you recall. We had European related risk. We had basically US related risks, to name a few. We're not there. So the orders of magnitude in global equity indices, ruling out the December 2015 hiking cycle episode, could be anywhere between 4 to 7%. In the span of time, if I may, of around 6, 7 months. And then the market rebounds 3 months after the first hike. That's what we have seen across the previous hiking cycles. So we think history will somewhat repeat themselves, and hence we have the buy on dips selectively in the equities world as we're heading into this first hike in the second half of next year.
We touched on a lot of stuff, and many of us aren't as well versed, not just in data, but in markets like yourself. Maybe if you could recap with us some of the risks that is on top of your mind, and perhaps the risks that investors should think about for 2022.
Yeah. So the main risk, first of all, is how this Omicron variant evolves. How is it going to impact, ICU rates, hospitalization rates, mortality rates, and beyond Omicron? How many more variants are we going to get out there? And what's going to be essentially the policy response? How well will policymakers be able to handle this? And how will economic agents such as consumers and corporates, how will they adjust to this environment? That's a risk that is almost unforecastable and unquantifiable, right? To be honest, because we don't know what each new variant is going to look at. That's point number one. The second point is, although we're comfortable that the Fed actually is on a gradual removal of accommodative monetary policy, it's not moving to tight monetary policy anytime soon. That's going to happen over the course of next several years. But in case the inflation that we're forecasting and market participants are forecasting as well, ends up being too conservative. Inflation ends up being like what we saw second half of 70s to early 1980s. I was like in middle school and high school at that point of time. I remember that time. Okay, it was strong, right? And bond yields just went up crazy. The bond market collapsed in the United States and has spilled over to emerging markets as well. I was reading the Wall Street Journal even then, despite my young age. But the bottom line is we're not there. We're not going to be there. That's not what we're anticipating. But if that happens, we got problems. It means that the Fed tightens monetary policy, probably according to not only the market, what the market is asking them to do, but potentially even more. And that's a significant risk. China hard landing risk. We can't rule it out because China is a black box for many people, even experienced people like myself who've been studying China since like the late 1990s. Okay. Um, if essentially we get a collapse of the property sector, we get a lot more event risk from credit related risks related to the property market. Evergrande was one of them, right? We're still struggling through that sector, how it's going to evolve, and how it spills over to the rest of Asia in terms of property sector collapse or essentially credit risk impacting Asian economies and markets. That is a plausible risk. We're giving you plausible risks, okay, not just any risk. The last plausible risk, very real, geopolitical risk related to China. All of a sudden, the American administration, President Biden, specifically coming out with a statement that, hey, China, I think Taiwan should do what it wants to do. So, that's a big statement. That's a big fashion statement. It's not really a fashion statement, it's a real statement.
Yeah.
That Straits of Taiwan issue, we're hearing, as you know, the Australians, the Americans, the British, India coming together to protect our navigational routes from the onslaught of China's aggression in our territorial waters. These are real risks. Middle East, don't know. That's always a matchbox. Right? It's a tinderbox. Anything can happen over there, right? Afghanistan's one of them. Don't know. There could be other geopolitical risk brewing in Middle East. So these would be some of our plausible risks that markets will have to contend with in 2022.
One item that I read early in December 2021 is that the population of China has peaked in 2021, and that the number of births will continue to be lower than the number of deaths from now moving forward until some dramatic policy changes have resulted in results, because we've seen some dramatic policy changes. Mainland Chinese can now have up to 3 children, for instance, 98 days maternity leave, subsidized wedding. The government is basically throwing everything to boost up their population numbers, but doesn't seem like anything is sticking. What is the long term view when it comes to the Chinese market, seeing the numbers of the population numbers actually declining? What's the story there for global growth, particularly in the long term view?
Yeah. So when we think about China, for some time this demographic dividend that it used to have, and that helped it record double digit growth because of basically expanding labor supply, right? They're not going to have that. That's one thing that's out of the equation to getting double digit growth in China. Our view on China, it's on a structural decline. We have over the course of 2022 to 2024, we're at 5.5% growth. Still pretty good for a large economy, but it's not no longer the gangbuster, 12% growth that we got heading into the global financial crisis in 2008. The second factor impacting China negatively is that the developed world, after a long time, they should have realized that ages ago. They're just realizing this now, that China's main intent is to dominate the world. economically, financially, militarily. Now, whether you like it or not, you and I like it or not, doesn't really matter. What is the policymaker thinking in developing market world? They don't like it because it erodes the balance of power in the world, and the mechanisms that will be utilized by the developed world, particularly the US, to ensure China doesn't become even more powerful economically, politically, or militarily is, curtail the trade with them. That's already happening, okay, in terms of trade policy. In terms of the sanctions on certain sectors able to list or type of goods allowed to be imported. And third, working with other countries in the world, major countries in the world, to ensure that our navigational routes here in Asia and going out into Africa do not get completely controlled by China, because that's a major strategic risk that everybody needs to contend with. So the economic and essentially geopolitical aspect means that the strong growth, and remember, the Chinese themselves essentially don't want a strong private sector, because onshore, in terms of Xi Jinping and his close allies in the government, in the administration, are of the view that, wow, the private sector is just going out of control. Right? We're losing the state-owned enterprises are losing control of the economy. The banks are basically, the state-owned banks are not basically the major conduits and markets in China anymore. So we need to rein in these guys. Otherwise we'll become obsolete. So you get not only the foreign pressure, but even the domestic pressure. So where's the growth, right? It's very difficult to make an argument of being bullish on China when you look at the on the other side, the directly opposite their adversaries in this part of the world, India. When we compare China, we don't compare it to like Philippines or Singapore or even Korea or Taiwan. Who
Yeah,
cares, right? Those are not comparable
yeah.
markets. The other big giant is, for practical reasons, India. So India is on a structural uptrend. It's got the demographic dividend going for us. It's got the new economy going for it. All these unicorns you hear about it, right? I mean, every time I speak to somebody, no jokes, I think they've become richer than me, which you never did see, right? Generally, locals were like far, in terms of incomes, much lower than what expatriates like myself are. We're nobodies in the Indian context anymore, to be honest with you. Okay, so there's that new economy aspect, and third, essentially, India never has had this long growth, long cycle. It's nonsensical to think about that like countries like China are different, and that their long cycle can go for like 50, 100 years. There's no country in the world, I can tell you three in the last 500 years, which have had long cycle, like 100 years plus. One, no surprise, the UK, Netherlands, and the US. That's it, nobody else. So you really cannot compare a place like China or even India. I mean, India will have its time when it peaks as well. Not now. Next several years, we will see that peaking because they're nowhere comparable to these, countries that we've seen observed in the developed world. So that's my key takeaway looking at the dynamics of China. Who benefits from this decline of China? Home based Malaysia, we're already seeing outsourcing, dislocation of activity, right? Coming to Malaysia, we see it in Indonesia, we see it in Thailand, to name a few. Southeast Asia is a major beneficiary of the structural decline in China, along with India.
Thank you for the wonderful insights, Chief Economist Dr. Jha. To conclude RHB Money Chat's episode, are there any last words of advice you would like to share with our investors?
Yeah, what I tell all investors, all types of investors, keep things simple. And I learned this not only on my personal experience, but from a good friend of mine, ex-colleague in Singapore. He's a established hedge fund manager. His mother has been able to outperform him since the global financial crisis. This is not a joke. And so he's doing 5 to 6% annual return since about 2009, 2010. and she's done 150% plus returns. You know what the person did? The mother invested in the US equity ETF. So if you want to keep things simple, you think about where are the least risks. There's risk all over the place. Make your calculation. You don't have to take my word for it. Where are the least risks? US is the place to be. 2, headlines. Headline will impact trading. If you're a trader, you need to definitely look at the headlines and trade around that. But if you're more of, and for me, trading is like 1 week, right? It's not 3 months, 6 months. That's not trading for me. 6 months, 12 months, you basically stick to the idea. We're on a pretty decent recovery path. You want to accumulate risky assets on dips. Third is factor in anything in your professional and in your personal life. This pandemic is going to be with us in 2022, could be until 2023. That's it from my side.
Thank you, Dr. Jha. That was Dr. Sailesh Kumar Jha, the Group Chief Economist and Market Research, Head of Market Research at RHB Bank. If you'd like to find out more about the 2022 Global Market Outlook, do leave your comments in the comment box. Our financial experts will reach out to you. Stay tuned for the next session of RHB Money Chat. And until then, have a great week, stay safe, and see you again soon.